Okay, good morning. I'll call this public hearing to order, the Banking Committee, Tuesday, February 27th, 2024. Um, Before we begin, I just want to acknowledge my co-chair, Senator Miller, is again not here today. The reason for that is because over the weekend, she lost her dear husband, Robert Bobby Miller, after a long and arduous battle with lymphoma. She had been by his side for several years, as long as she's been serving as co-chair of this committee, and getting him to his appointments at Sloan Kettering and back and forth and just by his side, devoted to him. So this is a deep and tremendous loss for her, and her colleagues here obviously are with her and thinking of her. So I would ask that we just have a brief moment of silence in honor of Bobby Miller and the Miller family. Thank you. Okay, so we'll get started here. A few housekeeping things. I just wanted to announce at the outset that due to the circumstances, we are going to be canceling the committee meeting that was to take place on Thursday, this upcoming Thursday, the 29th. With that, we will get things started. I would like to first begin by asking my ranking members if they'd like to offer any comments at the outset. Senator Berthel, start with you.
Thank you, Mr. Chair. And of course, my prayers and thoughts are with Senator Miller and her family. And the senator is a genuinely authentic and good person. And I would ask you to, as the good chair spoke to keep her and her family in your thoughts and prayers as well. On a lighter note, Mr. Chair, I would like to just take a point of personal privilege, if I may. We have a legislative intern in the committee meeting, the public hearing meeting with us today, who also happens to share the same last name as me. My son Matthew is here. Matt, if you would give a quick wave. He is a sophomore at Post University in Waterbury, as part of that class of 50 interns that we brought in for this session. And we're giving all of them the lesson of drinking out of a fire hose in this short legislative session. So with that, I have nothing else. Thank you, Mr. Chair. I appreciate the indulgence.
Thank you, Senator. Welcome, Matthew. You're learning from one of the best, but I'm sure you know that. Welcome to the Banking Committee, which is the best committee at the Connecticut General Assembly. I'm sure your dad has told you that. So we look forward to having you along. Representative Dilnick.
Thank you, Mr. Chair. And my thoughts and prayers go out to Senator Miller. It's tough to lose a spouse, and we all are thinking of you and keeping you in our thoughts and prayers. So we have a interesting agenda. Looking forward to the public hearing, and I turn it back to the good chair.
Okay. Okay, thank you. We'll get started with testimony today. We have about 15 speakers. Well, some of those are going to be panels or teams of people. As always, this committee reserves the first hour for public officials and agency officials. This morning, we're going to start with the Department of Banking and Matt Smith. Welcome, Matt.
Thank you.
Thank you. Just going to ask for.
Thank you very much. First, on behalf of the department, we'd like to send our heartfelt sympathies to Senator Miller and her family for her profound loss. She has worked so well with the department, and we're definitely going to feel that. So moving on for today, co-chair Doucette, ranking members Berthel, Delnicki. My name is Matt Smith. I'm the Director of Government Relations for the Department of Banking, and I'm here to testify on 2 agency proposals before you today. The first one, Senate Bill 124, an act concerning the Connecticut Uniform Securities Act. This proposal creates a state broker-dealer registration exemption for merger and acquisition broker-dealers who facilitate these changes. These merger and acquisition brokers work with sophisticated investors who are well-informed and understand the risks involved with these types of business transactions. Average investors are not involved in these transactions. This proposal also creates a notice filing fee of $250 for Tier 2 securities offerings in Connecticut, which is in line with other states. For reference, the department receives about 20 to 60 of these notice filings each year. In 2015, the Securities and Exchange Commission preempted states from requiring Tier 2 registration fees, but did allow for notice filing fees. Since then, the majority of states have enacted notice filing fees of this type. This proposal also authorizes the banking commissioner to censure or bar a registered securities broker-dealer, agent, investment advisor, or investment advisor agent based upon grounds enumerated in Section 36B-15A of the Uniform Securities Act, subject to the registrant's right to a hearing. This would bring parity with other enforcement powers and provide flexibility when enforcing the securities laws of the state. For particularly egregious violations, the department already has the authority to ban individuals from industries regulated by our Consumer Credit Division and among banks and credit unions. The Securities and Exchange Commission also has this same authority. The second bill, House Bill 5141, an act concerning shared appreciation disclosures, a particular issue Representative Delnicki will remember. This proposal introduces transactional financial disclosures as a requirement of lenders of shared appreciation agreements. Shared appreciation agreements are products where investors provide cash upfront to home borrowers in exchange for a share of the appreciated value of the home in a given time frame, usually 10 years. Sellers of these products are currently required to be licensed under our mortgage laws here in Connecticut. This bill requires consumers to be given disclosures unique to this product, including calculated appreciation amount, the appreciation-based charge, accrued or charged interest, principal amount to be repaid, the lender's total calculated share of appreciation or equity, any limit to the lender's share of appreciation or equity, annual amount to be paid, and of course, the equivalent APR calculation. Thank you very much for this opportunity to testify before you today. I can answer questions about these bills or any bills before the committee today. Thank you very much.
Thank you, Matt. Couple of questions on what the bills you just
Glasses on so I
spoke
can
about.
see you guys.
On 124, the Uniform Securities Act. So
Yes.
this, as I understand, is sort of a conforming change to federal law. Is that correct?
Yes, the first part, certainly the mergers and broker dealers, that is a conforming change, can already be done under federal law. The second part, again, notice filing fee, we were given the authority to do it, and we're joining the majority of states in allowing that.
Okay. And prior to or under current law, how are these transactions handled? What's the department's experience in dealing with merger and acquisition broker dealers, and how
I mean,
does that entail?
right now they're required to be registered with the department as just a regular broker dealer, of which the state has 180,000 registered broker dealers here in the state. The purpose in the 2015 federal law was to facilitate an ease of transaction among these merger and acquisition broker dealers. basically what we're saying now is that, like the feds, we just don't, it's more to add clarity to the industry, that they're not required to be registered here in Connecticut if if the law is passed. So again, they can already do it. We would have a hard case to, if we were to, try to take any action against these difficult, because they're already, exempted under federal law.
Okay, so if we pass this, what sort of oversight will we have and in what cases?
So we always have oversight for fraud in the securities arena. So if there's any fraud, a consumer complaint, typically though, what gives us a little bit of leeway with this to try to make this a little bit to reduce the regulatory burden in industry is that average investors are not really part of these transactions. They're complicated transactions that occur at a very high business level with all stakeholders knowing the risks and accepting those risks in that. So we're less concerned in these transactions about consumer harm
Okay,
or investor harm, I should say,
okay.
on that side.
And then moving on to shared appreciation, as you acknowledge, this was a topic that we dealt with, I think 2 or maybe even 3 years
2021.
ago. And basically what we did then was essentially to require them to be licensed as
As a mortgage product.
mortgage
Yes.
product.
Mm.
And now what we're doing is just adding essentially additional specific disclosures to this
Correct.
product, correct?
Correct.
Okay. Anything to report from the department as to activity in this space? Since
I
last time
don't
we
know off
talked
the top
about
of
it?
my head. I know that it's been, it's cooled down a little bit from the 2021 law. We haven't seen a whole lot of it, but we have worked with some industry partners in creating, along with the state of Maryland, creating a scheme for what these disclosures would be, the context of these disclosures and what would be required of them.
Yeah, okay. Yeah, as I was just telling Representative Delnicki, I came across one of these, I think it was last week, as a matter of fact, in the context of a
Mail solicitation?
real estate
Oh,
closing.
okay.
And someone was having to pay off one of these shared appreciation loans that
Oh,
that was made probably 10 years ago in that case, I think. And it was a builder who actually entered into the agreement with the homeowner at the time they closed on the property. And with with the market doing what it's doing, there was quite a bit of equity there and quite a bit of appreciation that was had to be then paid off to this builder. It was a second mortgage on the property. So, I just mentioned that because perhaps if these things are out there that and given what the market has been doing, we may see more of them
Mm.
and more
Sure.
questions about them
Sure.
because these agreements are confusing by their nature, I think, and people aren't thinking, okay, when I'm going to be in this house for 20 years or whatever, what is it going to look like then at the end of the term when I go to try to sell? So we may be hearing more questions if those agreements are out there. So I think it's good, and I agree with Rep. Delnicki. It's something that we ought to be looking at. Anyone else? Representative Delnicki.
Thank you, Mr. Chair. Have there been any complaints at all from anyone dealing with a shared appreciation agreement from when we instituted our last action to date?
not to my knowledge.
Can
And
you just-
I
can-
run
Can you
the
verify
consumer.
that?
I can. I run the Consumer Affairs Division too. I will double check that stat and get back to you. But to my knowledge, we haven't received anything.
Because I give you good credit on the fact that you have a good memory on my concerns about it the first time around. And
Mhm.
it's one of those products that I look at, and I look at what's going on with our real estate market, and I can understand where there could be some tremendous sticker shock to
Sure.
someone who has one of those and then suddenly runs into the situation that they're selling that house to buy another house, and they suddenly realize that, holy crap,
Right.
we got a situation here, and it's going to really, really bog the situation down in trying to make that second purchase, not realizing that we have had such appreciation in housing.
Correct. Again, I think it underscores the importance of having those disclosures for consumers. So, thank
So
you.
if you could follow up with me on
I
that,
will.
whether there have been any complaints whatsoever, and I'd appreciate that. Thank you, Mr. Chair.
Okay, Matt, one more thing before you go. I did want to take the opportunity to ask you, we have our Attorney General waiting in the wings, who's going to speak to us next about SB 121, which I know is
Sure.
a bill or concept that we've talked about for several years now. And I understand there have been some discussions, which we were pleased to hear between your agency and the Attorney General's office, and just wanted to ask you to comment on those discussions and where you see that
Sure.
at the moment.
Sure. So the discussions have been fruitful. We've been able to come to an agreement, particularly around the entities and individuals that are subject to the jurisdiction of the commissioner. We have a long and productive working relationship with the Office of the Attorney General. This really highlights and underscores that relationship. The department supports the AG's efforts and authority to enforce the CFPB, the Dodd-Frank Wall Street Reform Act. The substitute language that I believe is in possession of the committee, what the two agencies have agreed to, outlines a collaborative process that coordinates between the two agencies before the issuing of subpoenas to the entities that are regulated by the department. So we're happy that we were able to come to an agreement. Again, underscores the really highly productive working relationship we have with the office.
Great, that sounds good. Okay,
Okay.
any other questions? Seeing none. Matt, thank you for joining us.
Thank you very much.
Okay, and with that, we will move next to Mr. who is joining us online with some members of his team, I believe, as well. Mr. Attorney General.
Mr. Chairman and ranking members, can you hear me?
Yes, we can hear you. Good to see you.
Yeah. Hi, good to see you. I apologize for coming to you from New Haven, but it's a crazy day and the mayor let me as conference room. Thank you so much for giving me the opportunity to address the committee today and to speak about what we've come to know as the Dodd-Frank bill. Let me first say that I miss very much my very good friend Bobby Miller, and for those of you who didn't know him, he's a wonderful man and a wonderful father and husband and great friend back home in Stamford, and he fought his disease for a long time, and he fought it well, and frankly at various times had it beat, and so you know, we just miss him, and I just want to offer my condolences to Senator Miller and her daughters and their family, and just wish them peace and comfort in this difficult time. Moving on to the business at hand, I want to thank the Department of Banking and the Commissioner and Matt and Joe Chambers, the Chief of Staff, for working with us collaboratively on this bill and Senate Bill 121. Just by way of review, we've been here before on this bill, and for members of the committee knows better than anybody else that in 2010, our own Senator Dodd worked with then Representative Barney Frank to pass Dodd-Frank in the wake of the financial crisis in 2008. And as part of that, empowered both the Consumer Financial Protection Bureau and state attorneys general to enforce the terms of Dodd-Frank, federal banking laws, state banking laws, and state consumer protection laws to protect consumers, particularly in banking and financial transactions. As a follow-up to that, in 2011, this legislature, the state of Connecticut, in what is now section 3-129D expressly empowers and authorizes the Attorney General to bring a civil action under Dodd-Frank pursuant to its concurrent authority with the CFPB under the Consumer Financial Protection Act, the CFPA. One omission that we think is important to clarify is that while we can bring an action, so I could file a lawsuit tomorrow, it does not make clear that we have pre-lawsuit investigative authority to issue subpoenas, collect documents, seek testimony, do all the things the Attorney General does every single day in protecting Connecticut families and consumers and enforcing the law. And so while that authority, I believe, is implicit in the explicit statutory authorization in 3-129E, at this point, we think it makes good sense to clarify that in statute. Again, this has been the product of a lot of hard work by the commissioner and his team, and in particular, the chief of staff, Joe Chambers, in coming to an agreement in which the Attorney General's office and the department come together before we issue a subpoena. We give them notice, we can have a conversation about it, and we can work together collaboratively to move forward to protect consumers. Let me just say that this is really important to people here in Connecticut. After we saw what happened to Connecticut consumers with M&T Bank, and we talked about that on this committee last year. We've received more than 400 complaints and counting, and it would have been helpful with M&T to have clarified that we had that pre-suit investigative authority. It would be helpful in taking on, for example, for-profit colleges that maybe encourage students to take out tens of thousands of dollars in student loans and then the school closes. That might have given us the opportunity to protect students here in Connecticut, for example, students like those at Stone Academy. There's another, what I consider to be a scam going around now. You may have heard in the last week, there was news coverage of MV Realty and a product that they're shopping around Connecticut where they offer people a few $100s or a few $1,000s to sign away their rights to market their property for 40 years. And so people are, I think, getting snookered into signing away their rights for a small amount of money, where this company, MV Realty, has a cloud over their title that's on the land records, where if they try to sell their property, MV Realty gets 3% of the proceeds. And there are more than 400 consumer contracts of that nature. So a lot of issues out there. A lot of people need our help and need this committee's help. And passing Senate Bill 121 would go a long way to giving us the authority and the muscle to protect consumers and banking customers. Thank you. Happy to answer any questions.
Thank you, Mr. Attorney General. You touched there on what was going to be my first question. I was interested in to sort of break it down for the committee. I was going to ask, since we last convened on this last year, in the midst of, some activity in the banking world, I was going to ask if there have been any other instances in which you think these powers would be helpful. And then if you could maybe just describe, what Dodd-Frank is intending to capture in terms of the types of these or activities. You touched on it a little bit there, but I was going to ask you to elaborate.
So great question. And frankly, the list is so long of potential actions that we could take, because what the CFPA covers are financial transactions and products in which consumers participate. And so if you think about all the myriad financial products that are offered to consumers today, right? All these, not just mortgages, not just loans, not just commercial retail banking, but I talked about this MV Realty scheme, debt relief, debt collection. There are so many areas in which there are financial products or transactions that involve consumers, and the CFPA is intended to cover all of that. What's really important about the CFPA is that the CFPB, the Bureau, administers a consumer restitution fund. They've got, frankly, lots and lots of money there to try to help people who have lost money in a financial product or transaction that has gone awry, in which the CFPB and state attorneys general have authority, and we can come together and use the authority, leverage the authority of the federal government and the CFPB to not just take action and sue somebody and hold them accountable, but get money to victims. And so that, I think, is a critical component that maybe we don't always have at the state level, but that the federal government has literally in its pocket to help consumers across Connecticut. So, there's a lot more to say about that subject, but we need to be able to leverage that authority so we can get out there and help customers of M&T, potentially help students like those we saw at Stone Academy and are trying to help now, like victims potentially of MV Realty. Frankly, to the extent that there are complicated consumer financial transactions or products around solar panels, right? And people are being taken advantage of in buying solar panels or in the marketing of solar panels. That's another good example. So many areas in which we can weigh in and protect people.
No, that is a good example, and I agree. Oftentimes, and we see it when we're looking at legislation here, we get hung up on who is the regulator of primary jurisdiction, and do we go there, and how to coordinate that, on behalf of our constituents and consumers in the state. You illustrate why it would be helpful to have another venue or another place or someone else who can help defend the consumers in Connecticut when it comes to these things. So appreciate your testimony and for bringing this to us again for, I think, the second year, maybe the third.
Thank you, Mr. Chairman. Yeah, it's the third year, I think, and I want to note, that sometimes there's a question about who the regulator is and the regulator of first resort, or who has jurisdiction. In this instance, the way I see it is the regulator is the state of Connecticut, acting through the Department of Banking, the commissioner, and the attorney general, and the office of the attorney general. But we're all on the same team. We are the regulator. The state is the regulator, and so to the extent that we've been able to work together and find a path forward, that's because that's what we're supposed to do. And again, I want to thank the commissioner as my fellow teammate on these issues, because together we're the state of Connecticut as the primary regulator as to people here in Connecticut.
Yep, well said. Representative Delnicki.
Thank you, Mr. Chair, and good to see you, Mr. Attorney General.
Good to see you. Wish I was with you in person.
I appreciate that. You touched on MV Realty scam that is going on, and what precludes you from doing investigative work that you would need the Dodd-Frank provision in a situation like this?
So I don't think anything precludes me, and we are focused on MV Realty. I don't want to talk too much about what we're actually doing, but we're focused on MV Realty, obviously, very focused, and my team here, Pat Ring and Phil Miller and others, are focused on it. That being said, 3-129 empowers us to bring in action. We could sue tomorrow. What it doesn't do is make clear and explicit that we have the pre-suit investigative authority under Dodd-Frank to bring an investigation. And it would be helpful if the statutes clarified that. Now, that being said, MV Realty, to my knowledge, is not a state chartered banking institution. It is a private company offering a product. So maybe that's not entirely apposite to what we're talking about. I'm not sure that it does invoke the department's authority, but to the extent that it does, this clarifies that there's a process for us to come together and to formulate a plan to move forward, to investigate and take action to protect consumers.
So what you've just described here, that if we were to actually implement Dodd-Frank here, that would clarify that? Would it amplify that? Or would it make much of a difference?
I think it would clarify and amplify, frankly, and put bad actors on notice that if they try to rip off consumers in Connecticut, we're going to come after them.
Okay. Well, thank you, Mr. Attorney General. Thank you, Mr.
Thank you, Mr. Ranking Member.
Senator Berthel.
Good morning, Mr. Attorney General. Good to see you. Sorry you
Good to
couldn't
see you.
with us here in Hartford this morning. So I know that there's been some written testimony submitted by two of the large shareholders that represent banks and credit unions regarding this bill. And it looks like the overall theme was that they were hoping that your office and the department would come together and fix some of the issues. So we're going to hear from those shareholders a little bit later this morning as well. But I just wanted to offer my appreciation for finally getting us to a point where we think we can move something forward. It has been 3 years, I believe, that we've been talking about this, which I don't know, seems to be the amount of time it takes for us to get a lot of things done, which is okay. But I appreciate your efforts here, sir. Thank you.
Thank you.
Thank you. Anyone else? Anyone else? Nope. Seeing none. Thank you, Mr. AG.
Thank
And-
you. Thank you, Mr. Chairman. Thank you to the committee.
Okay, I believe, I just lost my list, but I believe the next person we have is Matthew Windsor, is that correct? No, yeah, he was with the last speaker. So yeah, Matthew Windsor is our next person to testify.
All right, thank you. Can you hear me?
Yes, we can hear you. The floor is yours.
Okay, thank you, Co-Chair Doucette and members of the committee for the opportunity to comment on HB 5141 concerning disclosures for shared appreciation agreements. My name is Matthew Windsor, and I'm an Associate General Counsel at Point Digital Finance. We are the nation's leading issuer of shared appreciation agreements, having helped over 11,000 homeowners access the equity in their homes nationwide. I'm testifying today in support of House Bill 5141. Point was the first shared appreciation agreement company to become a licensed mortgage lender in Connecticut, and we have had a strong working relationship with the Department of Banking. We are proud to say that our company was heavily involved in the development of the disclosure guidelines in HB 5141. Compared to mortgages, shared appreciation agreements can be a more complicated financial product, and as a result, consumer disclosures are especially important. We think this bill represents the industry's best practices for providing comprehensive disclosures in a readily understandable format for the average consumer. Point also believes it is important to acknowledge the differences in structure between shared appreciation agreements, as contract features can vary significantly from company to company. And we note that HB 5141's disclosure requirements are generally flexible enough to encompass these different product structures. While we are in support of this bill, we are seeking clarification with the Department of Banking on how some of these provisions will be interpreted. Nevertheless, we look forward to working with the regulators to implement this bill, resulting in enhanced disclosures and consumer confidence. Thank you again for the opportunity to comment on HB 5141. Please let me know if I can be of any further assistance to the committee regarding this matter. Thank you.
Thank you, Matthew. Did you submit written testimony for us today?
No.
Okay. That's fine. I would, it is helpful to us, when we go back, and are looking at these bills, as they move on to the next stage. So, if you do get a chance, that would be helpful, but, we appreciate
I'll do so.
being with us today. Any questions for Matthew? Anyone? Okay, seeing none. Thank you, Matthew.
Thank you.
Okay, next, my list is Lindsay Setti from CCM. Welcome, Lindsay.
Thank you. Chairman Doucette, members of the committee. My name is Lindsay Setti. I serve as the advocacy manager with the Connecticut Conference of Municipalities. I appreciate the opportunity today to provide commentary on House Bill 5144. CCM opposes this bill, which would reduce the interest on any tax liens filed by a municipality that have been assigned by the municipality. Municipal officials understand the desire to provide property tax relief during financial hardship, and CCM is a leading advocate for meaningful property tax relief in Connecticut, but this is not the way to do it. The current 18% interest rate is designed to encourage property tax payments to be made on time and compensate municipalities for the loss that occurs when revenue is not paid in a timely manner. When you reduce incentives for residents to pay taxes on time, you impact the taxpayers who do pay their fair share on time. At the end of the day, this bill makes it harder for municipalities to fund their budgets and provide the services residents depend on for education, public safety, and infrastructure maintenance. CCM urges the committee to oppose House Bill 5144 and instead focus on comprehensive property tax reform as a way to assist hard-pressed taxpayers. Thank you for your time. Appreciate it.
Thank you, Lindsay. So you may know some of the history of this bill, and really the main impetus for it from this committee, and I know there are other committees that have had similar bills dealing with the concept and the interest rate on tax liens. But the real impetus for this bill came out of complaints and concerns about the collection process for some of these third-party assignees of these tax liens. And rather, you said, you know, a bill like this could reduce incentives to pay the taxes. What we've heard when these tax liens get assigned is in fact the opposite, that people feel threatened or almost get into a hole so deep because of fees that accrue and all sorts of things that make it even harder for them to get out from under these tax liens. So I guess the question would be, I mean, I know not all towns, all of your member municipalities are in the business of assigning their liens. There's a myriad of different ways that you can enforce those liens. But I guess, I mean, what, from your perspective, could we do to prevent those sorts of aggressive collection practices that result from municipalities assigning these liens?
I mean, that is definitely a conversation we could have with our membership regarding the types of practices that these third parties take on. Where we come from as far as the 18% uniformity is in changing that 18%, you inadvertently then harm, the taxpayers that live in municipalities that don't have municipalities that then assign the liens. So that's where we're coming from as far as the uniformity.
But the municipality could try to collect it itself and still get the 18%.
Sure.
It's just the act of assigning it that creates a lot of the problems that we see. So again, I put that out there to the extent that some of your members who are in this business are listening, that we hope they look carefully at who they're doing business with when they do this, and look at other options for collection that might be better for taxpayers and not create these situations. Questions?
Thank you, Mr. Chair, and thank you for your testimony as a former municipal leader, as a former mayor. I asked the simple question that why should a third party have the same rights that a municipality would have? And by that, the concept of the 18% that a municipality has a right to, why should a third party have a like right that should be reserved just for the municipality?
I can't speak on behalf of our members with that. I mean, that's a choice that would be up to the mayor or first select person of that town.
So you're saying that as opposed to having it as 12% for, and bear in mind, 12% is a pretty hefty rate. 12% for an assigned tax lien, that the mayor or the first selectman should be setting that rate on the assignment to a third party?
I'm sorry, I would have to take that back to our members in order to clarify that. That would be up to them to make that decision.
Because again, it raises a red flag to me. And again, I come from the perspective, not just as a legislator, but as a former town leader. In some aspects, I'm concerned about the fact that we are granting a third-party entity that literally could be out of state, in-state, offshore, from buying it up and having the same rights that a municipality would have. Do you have any comment on that?
I understand where you're coming from on that. However, it is the municipality's decision to sell those liens in order to collect those funds that they then need in order to fund their budgets.
And I understand that. Just one last question. So this is not the first time we've had a public hearing on this. And we've gotten testimony from Bankers Association. At one point, 6% was a good number, and we received other testimony that 12 was a good number. And my personal gut feeling is 12 is a good number for an assigned tax lien. I would not want to take anything away from a town or municipality. How would that preclude a town or municipality from actually selling that tax lien if it were 12%? Because that's got a good return.
Again, I would have to go back to our membership and evaluate that. We are in favor of keeping it at a uniform 18% right now.
Whether it be for a third party or a municipality.
Yes.
Well, thank you for your answers there, and I appreciate you coming forward.
Thank you.
Okay, don't see anyone else. So with that, thank you. Appreciate you being with us today.
Thank you.
Okay, next, we're going to go to Jeff Gentes, who is online with us today. Hi, Jeff.
Hi, good morning.
Hi.
Thank you, Representative Doucette, Senator Patel, and we saw Representative Delnicki there, and other members of the committee. My name is Jeff Gentes. I work at Yale Law School, co-supervising a housing clinic, and I work at Connecticut Fair Housing Center as well. I'm here today in support of two bills. One is the bill that the Attorney General testified.
Could I
in
ask
support
you
of.
to speak, Jeff, could I ask you to speak up or just adjust your mic?
Sure. Is that better? Hopefully. I'm here in support of two bills. One is 5144. That is the bill that, excuse me, Senate Bill 121. That's the bill that the Attorney General spoke in favor of. And we're also here in support of 5144, which is the bill that the CCM representative just spoke in opposition to. We're in support of that bill. We think that anything that discourages towns from selling off their tax liens is a good thing. We've been in support of this bill in the past, and would love to see it enacted this year. And with that, gladly take any questions you may have.
Thanks, Jeff. I know you're working hard in the courts on some of these cases regarding the foreclosure of tax liens. I wonder if you could speak to what I just mentioned, which is the aggressive collection tactics that we see, particularly in court, with respect to these liens once they get assigned.
Yeah, so we see it in a few different ways. One is the towns themselves are the town, when the town does a foreclosure, the fees are low. The The attorneys tend to be less aggressive, and there aren't certain junk fees larded onto it. And we've had a more straightforward answer working through. When you're dealing with the towns, you can work through the tax collector, you can work through the legislative body of the town. You can do other things to bring up issues you may have with the town tax foreclosure. When they go off to a third party, it's better than it used to be, thanks to your efforts in 2021, but it's still worse in a lot of ways. You can get collection fees, you can get difficulty getting information. Every time you ask certain tax lien purchasers and their attorneys for information, the attorneys charge you for the privilege of answering. We had a situation where the gentleman in Danbury, we had figured out that he'd been overcharged by roughly $3,000, but it took us $1,000 in attorney's fees, charged by the tax lien purchaser, to learn that amount. And these folks, when they get foreclosures right from the outset, they're paying a bill that's not scrutinized, and would take progressing all the way to judgment to get any scrutiny on that. And at that point, you've incurred even more fees. So, so we support, like I said, we support anything that makes it less likely to sell these liens off. And 12% on a secured super lien investment is still pretty good. And if towns are desperate for the money, where they don't want the 18%, they need the money now, then the 12% is still a pretty good deal.
Okay, thank you. Any questions for Jeff? Anyone? Representative Paolillo.
Thank you, Mr. Chair. Jeff, just a quick question. You mentioned ongoing work with municipalities, and you heard the prior testimony of the speaker before you. Are municipalities more open to payment plans before you even get down the line with bringing in aggressive collection practices, attorneys, these types of filings with liens? Are they more apt to talk to the constituent, to talk to the resident about establishing a payment plan where they're getting some money up front and working with the homeowner and not having those added fees tacked on to what the original bill was?
They can. So I guess I would say they're easier to reach. They're easier to get answers from. You're easier to get a breakdown. You're actually dealing with the tax collector's office. You're not having to go everything through a lawyer's office and pay for that privilege. And municipalities, what we generally see is that they offer some type of plan. It's a one size fits all. So everyone's got it. They don't want to be cutting one deal for this person and a different deal for this person. So they offer a plan, and you can do it or you can't. Or you need to go out and get a loan or do something else to address the bill. In theory, the tax lien purchasers could offer different payment arrangements. In reality, they don't. It is aggressive hardball tactics, just the same. They sit back, they purchase typically multiple years of liens, and then just let that equity, let their debt grow while the equity shrinks for the homeowner. And then start the foreclosure, time it right so that they get as much equity as they can at that secured 18% rate.
Thank you.
Thanks for the question.
Rep. Delnecki.
Thank you, Mr. Chair. Philosophical question. Should a third party be given the same rights that would be given to a municipality in a situation like this?
No.
Thank you, Jeff. Thank you, Mr. Chair.
All right, thank you. Seeing no additional questions, Jeff, we thank you for joining us.
Thank you so much. And I appreciate the ability to testify remotely.
Okay, next we have Bill Marone. Bill. Good to see you, Bill. Welcome back to the Banking Committee.
Man, okay. Chair Doucette, ranking members, and the full Banking Committee. I'm Attorney Bill Marone. For those of you who may not know, I am president of the Connecticut Creditor Bar Association, and I'm here today to offer some general comments on Senate Bill 123 regarding coerced debt. In preparation for today, I was reminded back last session And I was happy to see both Karen Robbins and Megan Scanlon were here to testify today because they offered very powerful testimony that I left the hearing with having digested. And they very eloquently and directly exposed the potential issue that we're trying to resolve. I sit here today to offer general comments about implementation of how to best handle the issues. I think the bill is a very balanced and measured approach. However, as the judicial branch's testimony that was filed earlier today indicates, it's a much bigger ask than last year. It not only creates a brand new cause of action, it interfaces with state and federal banks. And I know this committee is always concerned about how far our scope can go. It also has interplay with both the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. So as a stakeholder from the creditor side, we recognize the issue. We want to be a collaborative party and resource to both the committee and the proponents of the bill to offer ways to get to the solution in that space. So that's all my general comments on the topic, and I'm happy to answer any questions, and we remain happy to work collaboratively to hopefully continue to work on this issue this session.
Thank you. Had a couple sort of practical questions if you've looked at this, and you're right, you reminded me that I think we were pretty early in the process last year when we had the proposed or the raised bill at the hearing compared to what we wound up with after we went through the committee process. And there may have been other amendments because I know this was being worked on throughout the session. So, you know, we wound up with the bill here. My understanding is that there are a few states, not many states, but a few states that have adopted this model. I wonder if you have any colleagues or who have.
Yeah, so
experience
that's
in
actually an interesting thing. When the bill language released, the scope of the bill, so to my knowledge, I know factually Maine has implemented a bill that's slightly different than this. And this is what I would call the California model. California's went into effect, I think, in 2022, the end of that session, and maybe went live in 2023. So when I saw that, I did reach out to people that were involved on that level, both as stakeholders in the negotiations on those bills, because I do know that was heavily negotiated from where it started. And to find out any practical concerns they've had since implementation. I haven't gotten response to that yet, but I'm still other trade associations that worked on that. I'm waiting to hear back from. So I think the bill does a lot of things that we asked for last session. And I mean, it offers a number of things that help to protect the creditor. But, you know, when we make a lift of this ask, you know, as judicial branch rightly points out, it's interfacing with both the practice book, the statutes. You know, I was trying to figure out where does it reside in the statutes? There's a portion that's probably a banking bill. There may be a portion that's family law, and there may be a portion that goes under Section 52 of the civil actions. So that was the piece from an implementation standpoint that made me think like, okay, if we're going to get it done, let's do it in a measured manner so that we don't have a number of unintended consequences where, you know, it creates more harm than good. But collectively, at least for the members that we represent, the idea of offering relief to people that have been sort of victimized by coerced debt is not something we oppose. It's just something in the implementation phase that we would want to take a measured and careful approach to.
Right. But I think from your perspective, I would think, you know, offering relief or a form or a venue to obtain relief is definitely one piece. But really what it does here is just adds more to the process, which I assume that you, in representing a creditor, would also be involved with, whereby, you know, we just have kind of a different process for dealing with these specific types of defenses, right?
Sure. Yeah. You know, because I thought from a litigation standpoint, that's where my eyes are. But really, most of these should be caught upstream prior to getting to a litigation channel where they're working directly with their lender or their creditor. And obviously, it's such a delicate situation. When and where people will raise this may differ in timeline and things of that nature. But I would think an overwhelming majority of them would never get to an attorney to litigate a case because they would have been raised earlier. So as I think about it, if it was a litigated case, in theory, there are special defenses you could raise right now. You could say it was duress and all of those things. So I agree with that. The judicial branch's concerns that they raised were sort of how declaratory and injunctive relief would interface with due process and things of that nature. So it's more of geeky technical law stuff from the litigation side that we would want to make sure that we don't mire into and then all of a sudden have, a constitutionality claim for some reason. I do agree though that you could probably cobble this together on your own if you had gone to law school and litigated for 20 years. So to be able to have it for a victim of abuse in a, maybe a family bar attorney who's aware of it, and give them a roadmap is well-founded. I respect that.
Right. Okay, thanks. Any questions? Representative Dilnick.
Thank you, Mr. Chair, and thank you for coming forward and make your comments there.
Thank you.
You did make a comment about causing more harm than good. Could you amplify that, go into that a little bit more? Because I kind of found it puzzling.
Well, most everybody who knows me finds most of my comments puzzling. So that is, you are not alone in that regard. No, in the more harm than good section, we want to make sure that we don't create a framework that makes it difficult both for the abuse victim and or the creditor to implement, right? We don't want to create a cottage industry where truly bad actors try to use this as a shield in an attempt to do that. And I think the framework does address that by allowing a knowingly false raised claim to subject somebody to attorney fees. It also has pains and penalty of perjury under the statement that they make. So I do think that there are some protections there. So it hasn't been live in other jurisdictions long enough to know how it would be used to create potentially the harm to either side of the aisle, whether it's the creditor and or the abuse victim. So if it was puzzling, I probably just said a puzzling comment.
So just to follow up on
Sure.
that. Am I correct that you basically said that to the best of your knowledge, up to this point, it has, what other states have done has not caused any harm to the victim and has been a help to the victim?
What I don't have is information about how often it's been used so far. It is so new, and this is a trend nationally that people are recognizing. This is a space that maybe legislation should help and offer relief. So I don't have any real world practical experience as whether it's even been raised in California yet. I've put out feelers and asked anybody if they've encountered it, but some of it is, I think the implementation timeline was similar to this implementation timeline, which would mean it didn't have a retroactive impact. It was debt incurred after a certain start date. So sometimes it takes a window of time for that to get into the pipeline before you have an opportunity to allow this mechanism to actually take place. Because the California bill, I think, may have gone into effect for debts after January 1st, 2023, or something along those lines, similar to the way our bill is for after debts occurred January 2025. So I thought I had it with me, but that would be my concern, is I don't know if it's been actually used yet. And I
So-
haven't gotten information on it.
So then you really don't know whether it's been used, and you really don't know it's caused harm,
That is
and
correct.
you really don't know it's caused help.
That is correct. The amount
Okay.
of stuff I don't know is astounding.
I appreciate your honesty.
Yeah, it's,
Thank
That's what
you.
I'm here
Thank you, Mr. Chair.
Thank you, Representative Delnicki. We're going to go online to Senator Cohen. That's a question. Senator.
Thank you, Mr. Chair, and thank you, sir, for your testimony. Really appreciate it. I will just point out, we were trying, I think, and, I'll defer to the leadership on this, to, take all of the feedback that we received last session, also using North Carolina as a model, though their bill has not passed. New York and Minnesota have not laid out any terms in terms of false actions made with respect to coerced debt. So we were really trying to look at, as you mentioned, California, North Carolina, with respect to the feedback we did receive on false motions. So I'm hopeful that now that this is passing in a number of other states, and you mentioned Maine, I'm not as familiar with their legislation. It would be great to have some input from those states. And I think, this is more of a comment than anything. If you receive some of that input and feedback, we'd love to hear what that is. But I think we've come to a good understanding and compromise in the language in order to ensure that the creditors are being taken care of, false motions are being addressed, but most importantly, that victims of this sort of abuse, this financial coerced control, can seek remedy and really move on with their lives after being substantially impacted.
I appreciate those comments, and I'm glad that you had an opportunity to come to the hearing, because as a proponent and sponsor of the bill, I appreciated the amount of effort, time, and thoughtfulness to the approach of the bill. So yes, I'll be more than happy to share any real life examples I get from the states that have done it. Maine's bill was actually, I believe, first in the country. It's a slightly different model. I actually, because of where we ended last year, I had always appreciated the opportunity to offer feedback to the committee. And it was very clear where we started this year that feedback was thoughtful and integrated into the approach. So, I just offer myself as a resource to the committee for any fine tuning, and appreciate the idea that we're looking into this space. So.
Okay, thank you. Anyone else? No, don't see anyone else. So appreciate your time,
Thank you.
Bill.
It was nice to see you.
Thank you. We have Bruce Adams on the list next. Hello, Bruce.
Motion
Thank you for joining us.
Representative Doucette, Senator Berthel, Representative Delnicki, and distinguished members of the Banking Committee. My name is Bruce Adams, and I am the President and CEO of the Credit Union League of Connecticut. It's a pleasure to be back here testifying in front of you today. Before I begin, I'd like to add my voice to the throng of condolences for Senator Miller's husband, and extend my hope for peace and healing in this time for her whole family. My testimony today is short and sweet. I have submitted some written testimony on Senate Bill 121. I won't rehash that, and I'm heartened to hear of the compromise that the Department of Banking and the Attorney General have arrived at, and look forward to seeing the bill in its final version. I wanted to focus, if I could, or let me start actually with 5144, the lien assignment bill. I think it's important to consider the sort of moral hazard that this statutory scheme sets up. That a community, a municipality, looking at the possibility of selling off these loans, perhaps at greater than par value, is a disincentive to actually engaging in meaningful collections activity with its residents. And so if there is a strong incentive to which there would be, obviously, for a debt buyer to buy a super priority lien that compounds at 18%, I should go into business doing that. I don't know why anybody wouldn't. So that's just the preliminary comment on that bill. With respect to Senate Bill 123 and coerced debt, when I was a young attorney at Day Pitney, we formed a program with junior litigators to work with the Interval House and go in on restraining order petitions representing women in the family court. And I've seen firsthand the truly damaging impact of financial control and coercion. It's not ephemeral. It's not, oh, this stuff also happens. The amount of terror in these women's eyes is palpable. So anything that we can do to address the issue of coerced debt is critically important. That said, I think it's important to get it right, and I will pledge my services and the the weight of the Credit Union League of Connecticut to working with the stakeholders on crafting a good language here in Connecticut. And with that, I commend myself to your questions if you have any.
Thank you, Bruce. You're very efficient in that 3 minutes. You hit a number of points, a number of different bills. Well done. Any questions for Bruce? No? So efficient. We have no questions for you at this time, but we appreciate you as always.
Thank you very much.
Thank
Thanks,
you.
Bruce.
Next on the list is Art Corey, who I believe is going to be joined by Tom Mangello. The double hitter.
Good afternoon, gentlemen.
Good
and
afternoon.
Members of the committee. Mr. Chairman, ranking members. It's good to be here. Before we get started, on behalf of Art and myself and the CBA and its member banks, we wanted to extend our sincerest condolences to Senator Miller and her family. Getting into what we're looking at today, obviously there's a number of bills on the agenda. We submitted 4 pieces of testimony total. We're only going to talk about 2 bills at this particular juncture. Number 1, Senate Bill 121, and then we're going to talk a little bit about the municipal lien assignment bill as well. We're actually very heartened to hear that there is good conversations going on between the Attorney General's office and the Department of Banking. We're encouraged by the direction. We're looking forward to seeing that language. I think as we reported to you folks last year, one of the key things that we're looking for in any type of a bill that moves forward would be to preserve the current protocols and cooperative approach that currently exist between the Department of Banking and the AG. This is a new approach from the standpoint that the bill gives, as you heard Attorney General Tong mention, gives them the authority to issue subpoenas before a lawsuit is begun, before an action is begun. That is new, that's different. Once again, we want to make sure that it basically works in a fashion that is fair and acceptable to all the stakeholders. So in short, we're looking forward to working with the committee, with the Attorney General's office and the Department of Banking, and appreciate the efforts that they put into it thus far. I'm going to turn it over to Art at this point, I think. And is there any questions before I do that with regards to the AG's bill? Thank you, Art.
As Tom mentioned, we'd also like to voice our support for House Bill 5144 on the assignment of municipal liens. We agree with much of the testimony that was already provided. When these liens are assigned, transferred to a private third party, we think the 18% interest rate is exorbitant. That accrues in some of these cases over long periods of time, eats away at a consumer's equity, which in turn harms the financial services industry who make loans on people's homes and lose the equity. The system is such that it makes it harder, we think, for financial institutions to work with homeowners to help them resolve their financial difficulty, their financial situations. We also believe or support the cap on attorney's fees, or rather the timing of when those can be charged. That is another source of possible eating away at folks' equity in their home. So we've supported this in past sessions and fully support it this session as well.
Great, thank you. Just sort of for clarification on SB 121, you have been working directly with the department or have been in conversations with the department and the AG's office in looking at potential revisions to that bill. Is that correct?
That's correct. The Attorney General's office and the Department of Banking were good to share the compromise language with us, which we've reviewed. We've shared it with our member banks. We're currently receiving comments from them on that proposal as with the compromise language in it, digesting it, and we'll be having, I think, further discussions about that and potential, further changes as we review those.
Okay, well, that's encouraging. We like to hear that, and just, certainly keep in touch. We're on the clock with our deadlines fast approaching. So we will wait for the white smoke from you all.
Understood.
Senator Berthel.
So thank you, Mr. Chair. I'm just going to take that one layer deeper, if I may. Have you been at the table in the discussions, or are you just getting the product of the work with the discussion between the bank on Senate Bill 121? Are you at the table, or are you getting the byproduct of the work that's coming out of their discussion?
We were not directly part of the conversations between the Attorney General's office and the Department of Banking. We, of course, confer with the Department of Banking on the bill, but not part of those conversations that have taken place between.
Okay, I just wanted to have that clear in my mind. Thank you. And I understand that I'm not putting into question the quality of the relationships that you all enjoy and need in order to get good things done. I just wanted that clear, and I would have, if I didn't think about it after Mr. Adams got up, I would have asked him the same question as well. Thank you, Mr. Chairman.
Anyone else? Anyone else? Seeing none. Thank you, gentlemen.
Thank you. Thank you.
Okay, we're moving on to Liza Andrews.
Good afternoon.
Good afternoon.
Thank
you.
you for having me. I'm Liza Andrews. I'm the Vice President of Government and Public Relations for the Connecticut Coalition Against Domestic Violence. Our 18-member organization serve approximately 40,000 victims of domestic violence annually. We'd like to thank the committee for raising this bill again this year to help us try to address some of the coerced debt that many victims of domestic violence face. Most abusive relationships involve some form of economic abuse, with coerced debt being one possible tactic that an abuser may use to gain and maintain control over their victim. Money is a very powerful tool that many abusers will use to keep their victims entirely dependent upon them. Coerced debt is generally considered non-consensual credit-related transactions. Those typically fall within three categories: fraudulent transactions using a partner's credit without their knowledge; coercive transactions using a demand and threat of consequence to compel a partner to take on a debt; or manipulative transactions, managing conditions or information to lead a partner to take on debt that they otherwise would not. So this might include forcing a partner to file fraudulent legal financial documents, overspending on credit cards, or coercing them to incur debt through threats of harm. The debt and resulting poor credit score can have long-term consequences for survivors, creating barriers to education, housing, and employment. Employers, landlords, and utility companies all make extensive use of credit histories during screening. For victims who do leave, impacts of coerced debt can result in longer shelter stays, which then impacts Connecticut's entire domestic violence shelter system, which already runs at over 150% capacity throughout the year. Credit abuse allows abusers to maintain control over the victim because they understand that without a job, rental housing, reliable transportation, and basic utilities, it is almost impossible for a survivor to be economically stable, secure, and independent. So this proposal, Senate Bill 123, will play an important role in helping victims to attain economic security by providing them with critical consumer protections. It provides them with a clear path to show that debt was coerced, be released from liability, and have it removed from their credit rating, thereby protecting their credit worthiness and allowing them to avoid the negative impact of debts that should be the liability of their abuser. The bill before you defines coerced debt, makes those who cause coerced debt civilly liable, establishes a process for victims to address an alleged coerced debt directly with a financial institution, and includes a hard stop on collection activities during the review period. Outlines the civil court process that a victim may initiate if a claim is denied, and following a victim proving in court that a debt was coerced, claimants can receive a court order allowing them to pursue the debt from the person who created it. Similar measures have passed in New York, Minnesota, and California, with a bipartisan bill pending in North Carolina. Connecticut has long been a leader in protecting victims of domestic violence, and we should join in these states in ensuring remedies for coerced debt. So we did include a couple of examples of substitute language in our testimony. So we've heard from some other parties that have some suggestions, also the branch, and we're happy to work with everyone to get this bill right, create these remedies, and keep the focus on the abuser who creates these debts. Thank you.
Thank you, Liza. Senator Berthel?
Thank you, Mr. Chair. Liza, thank you for your testimony and your advocacy for the bill. I have a question, and I don't know if you've appeared before the committee before, and we had this bill last year as well. Can you speak to or get to the committee the any kind of understanding of the number of victims in any given period of time?
Sure. I mean, I can't for specific for coerced debt. We could do a quick query of our membership. I mean, there have been some national studies. So I can certainly share those stats. Yeah.
So, yeah, I think that would be helpful. I think there's some, I don't want to speak for the entire committee, but I think there is some support to finally get this done this year. But I think it would be helpful for us to understand the scope of the number of victims here in Connecticut that are subject to that have been exposed to this. So whatever information you could provide, if you could send it to the committee clerk, that would be terrific.
Absolutely.
Thank you, Mr. Chair.
Well, anyone else? No? Okay, I just had one. I just wanted to point out, and you touched on at the end there, the judicial branch comments, which are hot off the press. And I understand there's more substantive comments behind what was I've asked, and I will share what I get with you certainly, and want you involved in that conversation. And it's, you know, that this is one of those devil in the detail things, because I think as we've heard in our discussion thus far today, I think there's support for the concept, and we're not going too far outside of the box to do this, but there's a lot of details in the procedure that need to get ironed out. So I don't know if you guys work with, and it's super technical and super legal, if you have an in-house counsel or outside counsel or anything like that, that that would probably be helpful. Because from what I've seen thus far on those comments, we'll have to get our pencils out on this. And again, I think not really reinventing the wheel in terms of the general concept that we've fleshed out here, which is good. But just some of those details. So
yeah, we want to get the details correct. We do not have someone in-house, but certainly several board members who might be able to support us in that effort. So.
Great, that'd be great. Okay. All right. Thanks, Liza.
Thank you.
Okay, next on the list is Joshua Gaffney, who is online with us today. Hi, Joshua. We can see you and we can hear you. You may proceed. Thank you.
Thank you, Mr. Chair and ranking members of the committee, for the opportunity to comment today on House Bill 5141. My name is Joshua Gaffney. I'm General Counsel for HomeTap Equity Partners, LLC. We support House Bill 5141, subject to a handful of clarifications. HomeTap is a provider of home equity investments, a form of shared appreciation agreement. We currently operate in 16 states and have helped more than 8,000 homeowners access the equity built up in their homes without incurring the ongoing payment obligations of traditional loans. Our customers have used HomeTap's financing to improve their lives by paying off high-cost debt, making needed home renovations, purchasing second homes, and funding small businesses. We obtained our mortgage lender license in Connecticut in 2023 and are planning to begin offering our product in the state this year. We fully support the goal of clearly defining the disclosure requirements for shared appreciation agreements and believe 5141 is a strong step towards protecting consumers and providing clear rules of the road for the industry. However, shared appreciation agreements are broadly defined and encompass products that operate in very distinct ways. We believe that 5141 could be improved by clarifying how certain points of disclosure should be handled where a feature may not apply to a particular product. Further, under many shared appreciation agreements, the amount that a borrower may pay is determined at the time the agreement is settled based on the then current value of the property. This makes it impossible to communicate more than an estimated APR based on certain assumptions at the time of application. To support consumer understanding and ensure that comparisons are capable across products, we recommend tying APR disclosures to a consistent set of hypothetical settlement scenarios. While we have a few additional clarifications to propose and will submit further written testimony, HomeTap appreciates the clarity that the bill provides and believes that these disclosures will serve as a model for the industry going forward. Thank you for the opportunity to speak today, and I'm happy to take any questions.
Thank you, Joshua. Did you submit written testimony to us?
We have not, but we'll follow up with some.
Yeah, as I said to the earlier speaker, it's very helpful as we go back and look
Absolutely.
at these bills, and for those of them in the committee who aren't here today. And you said you operate in 16 states currently?
We do.
How does what's proposed here compare to those states? And is there one state or other state, a handful of states, if you want, that stand out as good models?
No, today, this is largely regulated at the state level. Most states do not have any formal legislation or statutory framework governing these types of agreements, and they simply fall to existing common law to be managed. So I would say Connecticut and Maryland are really on the forefront of defining this space, and have been really great to work with throughout the process.
Good, thank you. Any other questions? Anyone? Okay, seeing none. Thank you, Joshua.
Thank you very much.
Okay. Hi, Karen. Thanks for joining us today.
Thank you. I testified in support of the bill remotely, but I'm thankful to be able to be here in person today to speak with you regarding Raise Bill 123. I've spent the last 3 years in Connecticut Family Court and trying and working to end my marriage and reclaim my financial independence after ending or enduring post-separation abuse that was directed by my ex-husband through continual and deliberate financial abuse. As I testified last year, in Raise Bill of an Act concerning coerced debt, residents of Connecticut really do need a strong, effective law that holds the banking industry and credit agencies accountable, and to punish those who would perpetrate coerced debt and psychological exploitation by way of financial abuse. It's for this reason I stand in support of this bill, which I believe improves on the version the Banking Committee unanimously passed last year. Importantly, the language in Raise Bill 123 would empower the financial institutions to partner with abuse victims to seek the repayment of the coerced debt from the abusers. It seems obvious that banks and credit lenders have no rational basis for targeting the victims of the fraudulent acts. It is long past time the financial services industry is given the authority to protect the abused spouses and also the elderly while holding the responsible parties accountable for demonstrable instances of fraud, credit card fraud, mortgage fraud, and use of forged instruments. My personal story is a cautionary tale for others in Connecticut when the absence of specific laws emboldens anyone willing to punish their loved ones through financial abuse. In the early months of 2020, I learned my ex had repeatedly stolen and misused my identity for personal financial gain all the way back to 2002. Through extensive research, countless hours talking to bank and credit card companies, customer service representatives, legal representatives, The reality of my situation was clear. He had stolen my information, opened countless credit cards accounts in my name, fraudulently taken out mortgage loans on my home, which was exclusively held in my name only, and stole from my children's 529 plans, even though I was the sole trustee. 4 years later, several financial institutions, after my hours of work, have done the right thing and have forgiven more than $100,000 in the credit card debt accrued in the accounts I didn't know I even had that my ex opened in my name without my knowledge and without my consent. Unfortunately, one credit card issuer has refused to drop the lawsuit, and I'm currently still in civil court in Connecticut fighting them, even though my ex admitted in family court that he was responsible for those charges. As such, I am still reliving the trauma associated with my ex's abuse and the claims in Connecticut Superior Court. Can I keep going? Do you want me to stop?
Sure. I suspect we'll have some questions as well, so we can definitely kind of continue
Okay.
the
I-
conversation.
The bank that held the mortgage on my former family home was not as kind as, no matter the amount of work I put in, and as a result, I was forced to sell my house and move in order to prevent foreclosure. And to summarize, I truly believe my ex got what he wanted to have happen. It's used to keep, now I'm going off script because I want to sum up, but financial abuse is used to keep abuse victims with the spouse. And when they've separated, that is obviously the most dangerous time. So then they're allowed to continue post-separation abuse, and this can go on and never end. And as I believe her name was Liza had mentioned, I went back to work as an attorney, and I want to get in here that it's also elder abuse, because I've been working to help through National Academy of Elder Lawyers to prevent financial fraud upon elders as well, because that's family members or close caretakers doing the same thing to the elderly as domestic abusers are doing to their spouses. So I see that happening and would like those laws to protect them as well. But 4 years later, I can't get a credit card. I can't get a mortgage. I can't get a lease on a car. I have to find someone to co-sign everything for me. My 21-year-old son is the one who gave me his credit card, despite the fact he was still in school. And this is coming, all of this work that went into it is coming, I had the background as an attorney, even though I was a stay-at-home mom. So the struggles I had doing it was with the help and background of an attorney with friends in the industry. And I still failed. My husband was still successful at this, and it still goes on to this day. And I'm still not rebuilt in any way, shape, or form. And so I think you asked Liza if there was an attorney or she had someone that might be willing to help you with the wording, and if I'd be more than happy to, if you're willing to work with someone
That would be excellent.
hasn't been doing this their whole career.
That would be excellent. Thank you so much. Really, it's so important, and I don't have to tell you. I don't think that it's very brave to come forward. I mean, we look at lots of different issues, especially here on the Banks Committee and realm of consumer protection, and we're talking about the consumer who's being protected. We rarely get to hear from them, and a lot of the time it's because folks don't necessarily want to relive these things where they've been victimized, and this is a really forceful example of that. So I appreciate you coming forward. And I was going to ask what was your experience in court, particularly in family court, because some of the concerns we heard from other members of the legislature last year had to do specifically with family court being the, court of primary jurisdiction to hear these issues, that everything should get resolved there. We wouldn't want anything that we're doing here to conflict with an order of the family court. It sounds like your issues were far from resolved in family court.
Family court at best is a law of equity. I have to be careful. Family court generally does not protect, you're told to leave, and this is a whole separate issue, and this is where Liza and CCADV, it's wonderful that they help, and that's true, but you leave, and then family court, there's a lot going on in terms of, do you bring up the abuse? Do you not? You can admit to the abuse. You could admit to the forged, yes, I forged her signature. That's my version of the forged signature with 2 witnesses that witnessed it and a notary. I took the money from the house. The money's gone. Now there's nothing to divide. If I were relieved of the debt, he admitted to the debt that I am in court now fighting. He admitted to that debt, even if the family court had said that he would take it on. If he chose to not pay that company, I would still not be relieved of the debt without a civil court ruling that said it was not my debt. So I firmly believe family court is not the place for this because there's too many. First of all, they're not versed in it. Secondly, it's too large of topic when it's usually, I happen to be an educated stay-at-home mom that stayed home and was, I'll take over the finances. And I think, people divide up things. So it never crossed my mind. And the person that can forge all of these documents and steal an identity from a smart, I like to thought was a smart individual, is a person that can also work with testimony and make things sound the way they were effective originally, and they can do so again. So I do believe that it needs to be outside of the realm of family court because it needs to not be handled in a court of equity. I guess that's my.
I agree. That's a important point. And I think this bill shows directly in that case how it would be helpful to have that prima facie evidence of guilt on the party who perpetrated this fraud on the record and indisputable and give you a mechanism to which to seek relief without.
Nervous. What the credit card companies do, the ones that let me off after hours, and you get different people in the executive offices, and I did everything on that list that's in the new bill, sent everything and certified and followed up. The companies that released my debt also let my husband off the hook. There was no follow-up. It wasn't, so it just, you go to say family court, and I was delayed because of COVID, but you go to family court and there is no ruling, there's just no more debt, and they don't go after the perpetrator. So there is no proof in family court without a ruling. It's just magically disappeared, and then they don't go after as a whole. Because financially, though they go after us, it's still a drop in the bucket to these big companies. So they don't want to they won't make it magically go away for the women, but they're don't go after the perpetrator.
That's an important point as well.
And as I said, I want to just advocate also for how it works with the elderly, because I do have in my this is an area of law that I went into when I went back to work 4 years ago, is I do see it, and I'm sure it has different underlying causes, but family members that use the undue influence, and take out it's not coerce, but the undue influence to take out large debt and funds that should be going to their.
We did a lot of work on that one last year, but the work never ends.
So I am, though nervous sitting here testifying, I'm happy to help. And it is emotional. I think it's always going to be emotional. But I do feel, because it's so emotional, that need to speak because so many women can't because they're exhausted at the end of all of this. And I am exhausted, but
definitely
I'm trying
appreciate-
to make sure we can get
Yep.
something done.
We definitely
So
appreciate
I
that.
appreciate the extra
Are
time.
there others who have questions? Rep. Delnicki?
Thank you, Mr. Chair, and thank you, Karen, for your story of what happened to you and the fact that there's been no accountability to the perpetrator, what happened to you. You know, we do a lot of good things when I think back to the protection of seniors last year. And I'm struck with the fact of just how important this issue is and just how much it has to be addressed so that there aren't any more victims like what happened to you. And the fact that you are an attorney, correct?
I am.
And it could happen to you.
That was
It
fun.
speaks to the concept that you're a very intelligent person, yet you became the victim. And the average person wouldn't have your skill set. And it makes you wonder how many other victims are out there that quite frankly haven't or don't want to come forward and make us all aware of just how big this problem is and just how devastating the problem is, and the fact that there needs to be action on this. And I think from listening to the conversation, family court is not the place where this should be. Because I'm not an attorney and I didn't sleep at a Holiday Inn last night. But the mere fact that a crime, what in my mind's eye, a crime, stealing literally identities, goes without punishment, and your credit history is basically destroyed, and you can't, from what I'm gleaning here, you can't put it back together. It says so much about what we need to be doing. And I don't know whether we get it right this year or not, but we need to get it right so that there aren't any more victims like this. And I thank you for coming forward. And I thank you for putting a face on it and making us all aware of just how devastating this can be and just how important it is for us to address it. And I want to thank you for being a brave person and bearing your soul here and telling us all about it so that we understand just what this means. And I thank you.
Thank you. Anyone else? Okay, well, Karen, thank you again for joining
Thank you.
us.
I very much appreciate the time. And if there's anything, obviously my story's very out there. And so if I can continue to tell it and help to the people that can help remedy the situation, I would very much like to.
Yes, please, we'll take you up on that.
Thank you.
Thank you. Okay. So I'm not seeing anyone else on the list, no one else on Zoom. So with that, we will adjourn this public hearing. Thanks, everyone.
Thank you, Mr. Chair.